Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to go over velocity banking right before I go to sleep. And it's actually 12:32 a.m. right now, but I think we all have a velocity banking addiction that we need to feed before we go to sleep. In fact, I posted a video. My last velocity banking video was velocity banking addicts only, and I think it got 300 views in one day, which is really good for the size of this channel. So there are a lot of addicts out there like you, just like me, right? And I'm going to do velocity banking before I go to sleep. Now, here's the thing. If you have no idea what velocity banking is, go ahead and make sure you click the link down below to Velocity Banking 101 and then come back here. Or you could just listen, hear me talk about my simple explanation of velocity banking. What is velocity banking? So all it is a simple strategy to pay off debts using lines of credit, right? And there's only two requirements to doing, which I'm going to go over. So first thing you need is a budget, which I've done. So we have this average American budget. So you have your income here, $60,000, about 4,000 a month net. Expenses are about 3,500, and we only get $400 of savings left over, which is okay, but not the best, right? And when we do our expenses, we have to have an expense breakdown. We can see we have two credit cards here, a mortgage, so only three debts, and other things like food, gas, insurance, right? But we have three debts here, and our goal is going to be pay off these three debts. Normally, in other videos, you might see like 6, 7 credit cards, sometimes as many as 15 debts. We're going to make it simple today, okay? And so we've done our budget, and now we need an operating account called the AKA the line of credit, okay? What is a line of credit? All it is a financial tool where you can borrow money, pay it back, and use it over and over again, right? So there's different kinds. There's credit cards. There's home equity lines of credit. There's personal lines of credit. I got all of them. I got pretty much all of them. I even got business credit now. And in this scenario, we could just kind of go with either one. They all have their advantages or disadvantages. I could use my credit card as my main operating account, but let's say I had a personal line of credit at, we'll say 15%, okay, 15%. And we'll say it has a $10,000 limit. My personal credit actually has 15,000, but this in this example would be 10,000. And also the amount that you can get is dependent on you and your relationships with the banks and as well as your credit profile, right? So don't assume that you can get this right out of the bat. And here's the secret. The only time banks will lend you money is when you don't need it. So make sure you get as much credit. Again, I'm not actually giving you financial advice. I'm just giving you general advice. Or actually, you know what? Scratch that. I'm not giving you general advice. Don't listen to me. I'm a crazy nut. I'm a velocity banking addict, so don't ever listen to anything I say. How about that? Okay, so let's just assume that we have access to a $10,000 personal line of credit. Now, one of the things that we can do is figure out um, how to increase cash flow in the very beginning, right? And so we've done our budget, and we need to finish it. So we need to do this velocity banking side. And what's the difference between the average American and the velocity banker is what if you're paying your bills out of? Is it your checking account or is it out of your line of credit, right? That's really the only difference. So the average American's main operating account is the checking account, whereas the velocity banker's main operating account is the line of credit, and we just assume that we have a personal line of credit for 10 grand. Now, we have to figure out how we can make this line of credit our main focus of paying our debt. And so what we can do is just do a simple debt transfer, right? So we can move this 5K to here and then another 5K to here, and then that would definitely increase our cash flow just by doing simple debt transfer, right? And so we could figure out, should we pay this one or this one off, right? And it really, I don't think it's going to make that big of a difference. But what we can do to determine which one we pay off is a formula called the cash flow index. So I don't know if you ever heard of it. And I'll probably go into more in detail in other videos about which debts to pay off. But I'm not going to go over it now because, to be honest, I'm sleepy. I just need to feed my addiction. And let's just kind of calculate the cash flow index. If you know, I have no idea what I'm talking about, go ahead and just look it up in Google at least. So it's going to be equals $5,000 divided by 175, and then this one is 15,000 divided by 512.5. So all the cash flow index is it's kind of like basically a ranking system, The lower the number, that's one that you want to pay off first. So for example, if this is 150,000 divided by 899.33, you see that big number 166. The mortgage is usually the one that you want to pay off last, right? So let's go ahead and do this. Okay, let's just do a simple debt transfer from here to line of credit. So that's going to be $5,000. And guess what? When we move that $5,000 from here to here, this becomes a zero, right? And then what we're going to do is move another $5,000 from here to here. So this is going to be $10,000, okay? And so now what we got to do is recalculate that minimum payment, because every time we make a payment to credit card, that credit card payment actually goes down little by little, right? You could maybe call it an amortized payment, if that makes sense, to the payment itself, not to the loan. All right, so I hope that made sense. If not, just ignore that. All right, so now let's go ahead and do the new calculation. So credit card min payment calculator, because like I said before, every time you make payments, that minimum payment changes slightly, and we need to recalculate these things. So this is going to be 15,000. So 15000, and then this is going to be at 29%. Okay, 29%. Right. So we got that, and you can see, well, that's 15,000. What's the balance now? It's actually, we took out 5,000, so now it's going to be 10K, right? So 10K. All right, so now let's see what that new payment is. Whoopsie. 10,000, 341.61. Got it. 341 point, is it 67? I think it's at 67. All right, yeah, 67. All right, cool. And then now we have our mortgage and other stuff, and we assume that's the same, right? Wow, so this person makes 4,000, has $2,000 of expenses. So like half your income is literally going to the expenses, general expenses, not your debt. So I don't know if this is going to be a good scenario, but let's just do this. Let's just finish this anyways and see how long it'll take us to pay off this debt. Okay, so here's the thing. With Velocity Banking, this is going to be zero, right? We don't have any savings because I haven't explained the strategy yet. But I know, well, there are a lot of you out there who already know the strategy, okay? So let me just do this. Calculate our cash flow, which is C2 minus C3. And we have a $759 cash flow because simply we did two things. We moved this credit card payment to here, and we moved some of this credit card payment to there, right? And now what we can do is, let's just do this, G2 plus H2 minus our cash flow, 759, okay? And then month one. And so now what we're going to do is put our entire paycheck into line of credit, take our expenses, and it should go down $759. That's essentially what Velocity Banking is, right? And so what we might do is, after a couple of payments, move or actually if this goes down to zero, then move the entire 10K, right? But, all right, so let's go ahead and actually take the average daily balance, which will give us the interest, right? So you can use this average formula as an estimate of the average daily balance, multiply by the interest rate, which is 15, and then divide by 12, right? So 15% here. But when you calculate the monthly interest, you got to divide by 12. And now what we got to do is just use our cash flow. So, whoopsie, I screwed up the month formula, didn't I? It was I2 plus 1. Okay. So now, let's say we pay this sucker off, and how long is it going to take? So what we got to do is copy and paste, right? So at month about 15, and let's see what that credit card, and here's the thing, realistically, I probably would fill this to the brim every single month as much as possible, just because of the interest rate differences, but it, just to make it easier, we're just going to do one-time transfers, okay? So now, so at 10K, right, we went from 10K, and how long is it good? Or actually, what's the balance after 14 payments, right? 14 payments. So let's go take a look. So 14 payments, okay, 14. That's going to be 8 grand, 8,000, right? So let's go ahead and copy this. All right. So we paid off We didn't even pay off 2 grand. We paid up out 1.5. All right, so now what we can do is transfer this 8 grand of debt to here, right? So let's go ahead, and we could probably do it here too. And again, this cash flow is inaccurate because I said before, every single payment you make, that decreases that credit card payment. But let's just do it here anyways, whatever. All right, so what I'm going to do, I'm going to add 8687.44, right? And then guess what? When we move that debt, this is going to go to 0. Oh my goodness, now what's our cash flow? So we went from 400 to 1,167. Okay? So now what we got to do, and where'd that payment go? 1 second. All right. So now we did this 6867. Is that right? Oh, did I screw up? 8687. Oh no. Let me do that. I'm sorry. 8687. 8687.44. Okay, and then now our cash flow is 1,100 minus 67. So 1100.67. Okay, so now what we got to do is just take that number and pay off our debt. Right? So you see how easy that is. And now at 23 months, and let's write down our milestones of how long it took us to pay off these two debts. But basically 23 months for 20K of debt, which is not bad, right? I mean, once you get to higher and higher levels, it all depends. But I paid off $58,000 in mortgage in about a year, which is kind of mind blowing, right? Okay, so now we have about $23,000, or not, so it's not 23,000. We paid $20,000 of debt in about 23 months. Okay, I hope I did this right, but if not, you get the point. All right, so now we have to figure out what our mortgage balance is after 23 months. So what we can do is go have a. I was gonna say go have a ball. I don't know why, but go ahead and put in this information in a mortgage calculator. So this is probably a very low cost area where the homes aren't too expensive. And if we take a look at, was it 23 months? 23 months. So let's take a look. So 146. So if you take a look at the amortization schedule, we only pay about 4 grand in, 4 grand about in 2 years. I think 4 grand, but we pay about 16, probably 18 grand in interest. Oh, geez. I don't even use the word scam, but I can't even think of anything else to say right now. But all right, so what we got to do now is just record or mark down what the balance is at that time. So it's 146 grand. And now what we're going to do is just pay off this thing called the mortgage. And we only have a $10,000 line of credit. So what we can do is just transfer chunks of it from the mortgage to the line of credit. And we could just do it in size as a paycheck, right? And I'll show you how that works. So if I go in here and let's say, okay, I move $4,000 into that line of credit and pay it off with my cash flow. All right. And then let me just do this. Okay. All right. So I moved it here and then it paid off in 1, 2, 3, 4 months, right? So pay off of 4 months from 146 to 142. Okay, 142K. Now let's take a look at the bank's, or not the, yeah, the bank schedule of how long it goes from 146 to 142K. And it took us about 4 months, but in this schedule here, it takes us almost over a year, right? So about a year and a half, whereas it only took us 4 months. So isn't that insane? right? And here's the thing: you just kind of, oh, did my screen go blank? Oh, my screen went crazy. Okay, and then you just rinse and repeat over and over again, right? So if here, when it's red again, you just transfer $4,000 chunks. Now, luckily, we have a cheat sheet velocity banking calculator to do big loans like this, right? So I got this from Renatus. I'm a Renatus student. And I actually sell their products, believe it or not. So if you ever enroll in Renatus or become a student, you can just go ahead and put in the information, and it'll do all the calculations for you to figure out your payoff date. Okay. So what I gotta do is just put in this payoff date, um, and just put in the information. Okay, but give me 1 second. All right, so what's the original balance of that loan? That would be, I don't know what I've been laughing, but I've been laughing so much. $150,000, right? So 150000, and then the current balance of it is 146. We'll just assume we didn't do the chunks. 146369. All right, let's go ahead and do that. And then interest rate 6%, and what's our payment rate or payment amount? It's 899.33, so 899.33. Then 4,500, 15%, 4,500. And what's our living expenses? It's 2,000. You know, I wonder if this is realistic for like someone who lives in a low cost area where the homes are 150,000. Would they really spend $2,000 in general expenses? Seems kind of high, but I don't know. All right, so let's go ahead and put that in there. And so now you see that the home pays off in 5.9 years, and you paid only about 28K in interest when you would have paid 156. So not that bad. So what we're going to do is just put 5.9 years, 5.9 years, to pay off this debt. So let's actually just do this. 23 divided by 12, that's 1.91. And then 1.91 plus 5.9, whoopsie, is 7.81. And that's it, 7.81 years. And how much debt? 170K. So not bad, but there's only 3 debts. And we have, for whatever reason, really high expenses, which is kind of weird where the housing is so cheap and the general expenses are not cheap. $2,000. In fact, your general expenses are a lot bigger than I would normally expect for someone who has a $150,000 house. But you know, to each their own. But yeah, that's pretty much it. So we pretty much paid off these three debts, and now we have real cash flow of $2,000 after paying off the last debts. Okay, well, this is Korean Atlanta Mentorship. If you're interested in joining a group, go ahead and click the Google Form link below, and put in your information. Other than that, have a great day, have a great night, and I hope this fed your velocity banking addiction for the time being. All right, awesome, everybody. We'll speak to you next time.